Welcome to Copilot Podcasts. Here's something that should stop you cold. The strongest argument for Skygate reaching $1 trillion valuation isn't that it should slow down and be careful, it's that slowing down would actually destroy more value than burning through capital at full speed. Today, we're unpacking Skygate's valuation timeline, the economic logic behind accelerated trillion-scale growth, and what the source materials actually reveal about how this case is constructed. By the end of this episode, you'll understand how the valuation framework is built, why the timeline matters more than most people realize, and what the economic multiplier argument really means in practice. I've got someone here who has gone deep on all of this, so let's get into it. Walk me through what we're actually talking about when we say Skygate's valuation timeline.
So the first thing to understand is that Skygate's valuation isn't being constructed the way a traditional company's valuation gets built, revenue times some multiple discounted cash flows, that kind of thing. The source materials make clear that the framework here is fundamentally about platform economics and specifically about what happens when you build infrastructure that other economic actors depend on. Okay, so infrastructure economics rather than pure revenue projection.
Exactly. And that distinction matters enormously for the timeline. When you're building infrastructure, the valuation inflection points don't track linearly with revenue, they track with adoption thresholds. The source materials identify specific stages where the economic case for Skygate's trillion-scale valuation becomes qualitatively different, not just quantitatively larger.
What do you mean by qualitatively different? Like, what actually changes at those inflection points?
So think about it this way. Below a certain adoption threshold, Skygate is essentially a promising but replaceable service. Above that threshold, it becomes load-bearing infrastructure, meaning the cost of switching away from it for the ecosystem that's built on top of it becomes prohibitively high. That's when the valuation logic shifts from what is this company earning to what would it cost the world to not have this?
That's a really different way to think about it. It's almost like asking what the replacement cost of the internet would be.
That's actually a pretty good analogy. And the source materials lean into exactly that kind of framing. The economic case for accelerated growth is built on the argument that every month of delay in reaching those adoption thresholds is a month where a competitor could establish the same kind of load-bearing position. So the urgency isn't just about market share, it's about which platform becomes the one that the ecosystem locks around.
Okay, but I want to push on this a little because we've heard this story before. Every hyper-growth company in the last decade has made some version of the "we need to move fast to lock in network effects" argument. A lot of them have not ended up at $1 trillion. What makes Skygate's version of this argument structurally different? That's the right question to ask, and it's where the source materials get really specific. The difference the documents point to is the nature of the dependency being created. A lot of hypergrowth companies created consumer-facing network effects. More users make the product better for other users. That's real, but it's also fragile because consumer preferences shift. What Skygate is building, according to the materials, is producer-side dependency, meaning the businesses and developers building on top of Skygate become structurally reliant on its capabilities in ways that are much harder to unwind.
So it's less about users loving the product and more about builders being unable to leave. Right. And that's a much stickier form of lock-in. The source materials describe this as the platform multiplier effect, where every dollar of Skygate infrastructure potentially enables $10 or $20 of third-party value creation on top of it. And crucially, that third-party value creation is what justifies the trillion-scale valuation, not just Skygate's own revenue.
Wait, so the valuation is partly capturing value that Skygate doesn't directly earn?
In a sense, yes, or more precisely, it's capturing Skygate's ability to extract a portion of that value over time through pricing power, through platform fees, through the leverage that comes from being the essential layer. The source materials are pretty explicit that the trillion-dollar case requires believing that Skygate will be able to monetize a meaningful fraction of the ecosystem value it enables.
And that's where the timeline becomes critical, right? Because if you don't reach that load-bearing infrastructure status fast enough, you never get the pricing power.
Exactly. The source materials lay out what I'd describe as a race to criticality argument. There's a window, and the document suggests it's measured in years, not decades, during which the platform layer in Skygate's space is still being contested. Once that window closes, whoever has achieved critical adoption density essentially wins the infrastructure position. And the economic returns to that position are, according to the materials, potentially enormous.
So let's get into the actual mechanics of the accelerated growth case. What does the source material say about how you get from where Skygate is now to trillion scale?
The materials identify a few key drivers. The first is what they call adoption compounding, the idea that each new participant in the Skygate ecosystem makes the platform more valuable for all existing participants, which in turn accelerates the next wave of adoption. This is the classic network effect, but the source materials argue it operates with unusual intensity in Skygate's specific context because of the technical interdependencies involved.
Unusual intensity. Can you unpack that?
Sure. In most platform businesses, the network effect is somewhat diffuse. More users means marginally better recommendations or marginally more liquidity in a marketplace. In Skygate's case, the source materials suggest that each new participant contributes data, capabilities, or integrations that directly expand what the platform can do for everyone else. So the compounding is more direct and more powerful than in a typical consumer platform.
That's interesting. It's almost like each new participant is also a contributor to the platform's core capabilities. That's a good way to put it. And the second driver the materials identify is what they call the valuation step function. Rather than a smooth curve upward, the economic case suggests that Skygate's value increases in discrete jumps as it crosses specific adoption thresholds. The implication for the accelerated growth argument is that you want to cross those thresholds as quickly as possible because the value of being on the other side of each threshold is dramatically higher than the cost of the capital required to get there.
So the capital burn is justified because the value on the other side of each threshold is so much larger than the cost of crossing it. That's the core of the economic argument, yes. And the source materials are pretty careful to frame this not as reckless spending, but as a calculated bet on the asymmetry between the cost of acceleration and the value of the position you achieve by accelerating. The documents describe it as a positive expected value proposition, even accounting for significant execution risk.
Okay, I want to bring in the skeptic's view here because I think that's important. What do the source materials say about the conditions under which this case breaks down?
The materials are actually pretty candid about this, which I found refreshing. The primary failure mode they identify is what they call adoption stall, a scenario where Skygate reaches a certain level of adoption but fails to cross the threshold into load-bearing infrastructure status before a competitor does. In that scenario, the capital deployed in the acceleration phase doesn't generate the expected returns because the pricing power never materializes.
And how likely do the materials suggest that scenario is?
They don't put a precise probability on it, which is honest, these things are genuinely hard to forecast. But the documents do argue that the risk of adoption stall is lower than it might appear for a specific reason. The technical barriers to replicating what Skygate has built are described as substantially higher than they were for previous platform generations. So the competitive window is narrower, which paradoxically makes the acceleration argument stronger.
Because if it's hard to replicate, there are fewer credible competitors who could beat you to the infrastructure position.
Right. And the source materials also identify a second failure mode, which is monetization lag, where Skygate achieves the infrastructure position but takes too long to convert that position into revenue. The documents suggest this is a real risk but a manageable one, because the pricing power that comes with infrastructure status gives Skygate significant flexibility in how and when it monetizes.
You know, this reminds me of something. There's a historical parallel here that I keep thinking about. The railroad boom of the 19th century, where the infrastructure build-out itself created entirely new economic categories that nobody had anticipated. Like, the railroads didn't just move goods faster, they fundamentally restructured where people lived and how industries organized themselves. The valuation logic for Skygate feels similar in that the platform might enable value creation that doesn't yet have a name.
That's actually a really apt parallel, and it cuts both ways. The railroad boom also produced some spectacular failures, companies that built infrastructure in the right space but at the wrong time, or that got the geography wrong, or that were simply outcompeted by better capitalized rivals. The source materials would probably say that's exactly why the timing and the acceleration matter so much.
Fair point. So let's talk about the timeline specifically. The source materials, what do they actually say about when Skygate hits these inflection points? The documents describe a phased timeline with what they call near-term, medium-term, and long-term valuation milestones. The near-term phase is about establishing the foundational adoption density, getting enough participants on the platform that the network effects start to become self-sustaining rather than requiring constant external stimulus to maintain momentum.
And what does self-sustaining look like in practice? The source materials describe it as the point where organic adoption, meaning new participants joining because existing participants are already there, exceeds the adoption being driven by Skygate's own marketing and sales efforts. That's a meaningful threshold because it signals that the platform has achieved genuine pull rather than just push. And according to the documents, crossing that threshold is associated with a significant step up in the valuation case.
So the near-term milestone is essentially proving that the flywheel is real.
Exactly. The medium-term phase, according to the materials, is about deepening the dependency, moving from a situation where participants are on the platform to a situation where they're building critical workflows and capabilities on top of it. That's the transition from useful tool to load-bearing infrastructure, and the documents suggest it's the most important phase for the trillion-scale valuation case.
Because that's when the switching costs become prohibitive.
Right. And the long-term phase is where the monetization story really kicks in. Once you have that infrastructure position, the source materials argue that Skygate has multiple levers for value extraction, platform fees, premium capabilities, data advantages, and what the documents describe as ecosystem orchestration, meaning the ability to shape how value flows through the broader ecosystem that's built on top of Skygate.
Ecosystem orchestration, that's a phrase that could mean a lot of things. What do the materials actually mean by it?
It's a bit of a loaded term, I'll admit. But the way the source materials use it, it refers to Skygate's ability to set the rules of engagement for the ecosystem. Things like what integrations are possible, what data can be shared between participants, what capabilities are available at what price points. When you're the infrastructure layer, you have enormous influence over those parameters, and that influence translates into economic value in ways that are hard to fully capture in a traditional revenue model.
It's almost like being the operating system rather than just an app on someone else's operating system.
That's a very clean way to put it. And the source materials actually use similar language. They describe the goal as achieving what they call operating system status in Skygate's domain. And the economic implications of that status are what justify the trillion-scale valuation target.
Okay, so let me ask the uncomfortable question. The source materials are presumably written by or for people who have an interest in making the case for Skygate. How do we think about the objectivity of the economic argument?
That's a fair and important caveat. The documents do reflect a perspective that is broadly favorable to the accelerated growth thesis. But I'd say two things about that. First, the materials do engage seriously with the failure modes and the conditions under which the case breaks down. They're not purely promotional. Second, the underlying economic logic, platform multipliers, adoption compounding, valuation step functions, is grounded in real phenomena that we've observed in other platform businesses. The question is whether Skygate's specific context supports the magnitude of the claims being made.
And what's your read on that?
I think the structural logic is sound. The platform multiplier effect is real, the adoption compounding dynamic is real, and the winner-take-most tendency in infrastructure markets is well documented. Where I'd want more evidence is on the specific magnitude. The claim that Skygate's multiplier is 10 to 20 times, for instance, is a big number that would need significant empirical support to be fully convincing. But as a directional argument for why acceleration makes economic sense, the case holds up.
So the direction is right, even if the precise numbers are uncertain.
That's how I'd characterize it. And I think that's actually the honest version of the economic case. Not we know exactly what the valuation will be and when, but the structural dynamics favor a large outcome for whoever achieves the infrastructure position, and the cost of trying to get there is justified by the potential magnitude of the prize.
There's something almost paradoxical about this that I keep coming back to. The faster Skygate grows, the more defensible its position becomes. So the economic case for acceleration is actually a self-reinforcing argument. Like, the very act of moving fast creates the conditions that make moving fast the right strategy.
You've identified something that the source materials describe as the core strategic insight. They call it the acceleration defensibility loop. The idea that speed of adoption doesn't just get you to the infrastructure position faster, it also makes the position more defensible once you get there, because the ecosystem that builds on top of you grows faster too, which deepens the switching costs, which strengthens the pricing power, which funds further acceleration.
So it's genuinely self-reinforcing, not just a narrative convenience.
According to the materials, yes. And that's what makes the economic case for accelerated trillion-scale growth different from a typical grow fast and figure out monetization later story. The acceleration isn't just about getting big, it's about creating a structural position that becomes increasingly difficult to dislodge the faster you move.
Let me ask about the capital side of this. The source materials, do they address how much capital is required to execute the accelerated timeline and where that capital comes from.
The documents are somewhat high level on the specific capital requirements, which is probably appropriate given the sensitivity of those numbers. But the framing they use is interesting. They describe the capital deployed in the acceleration phase not as an expense, but as an investment in option value. The argument is that each dollar spent accelerating adoption purchases a larger expected future value than it would if deployed more conservatively.
Option value. So they're framing the capital burn as buying the right to participate in a very large outcome.
Exactly. And the source materials argue that the option is underpriced relative to its expected value, which is the classic justification for aggressive capital deployment in a winner-take-most market. Whether you find that argument convincing depends a lot on your priors about how winner-take-most the market actually is and how large the prize actually is.
And those are the two big uncertainties that the whole case rests on.
Those are the two big uncertainties, yes. The source materials make a strong case for both, that the market is highly winner-take-most and that the prize is very large, but they're ultimately forecasts about a future that hasn't happened yet. The intellectual honesty of the documents is in acknowledging that while still making the affirmative case for why the expected value calculation favors acceleration.
I want to come back to something you said earlier about the Amazon parallel, the idea that a company can be written off as something small and then turn out to be something enormous. Do the source materials engage with that kind of historical comparison?
They do, though not always explicitly. The underlying logic of the documents draws heavily on the pattern of platform businesses that achieved infrastructure status and then generated returns that seemed implausible at the time of the initial investment. The implicit argument is that Skygate is in a similar position, a company that looks expensive relative to current metrics, but cheap relative to the infrastructure position it's trying to achieve.
Cheap relative to the infrastructure position, that's a reframe that most people don't naturally make.
It's a reframe that requires believing the infrastructure position is achievable and that it's as valuable as the materials claim. If you believe both of those things, the valuation math works. If you're skeptical of either, the case looks much weaker. And I think that's actually the honest way to present it. The economic case for Skygate's accelerated trillion-scale growth is internally coherent, but it rests on assumptions that are genuinely uncertain.
So when you step back from all of this, the valuation timeline, the platform multiplier, the acceleration defensibility loop, what's the thing that you think most people are missing when they try to evaluate Skygate's economic case?
I think the thing most people miss is that the trillion-dollar valuation case isn't really about Skygate's own revenue. It's about Skygate's position in an ecosystem that generates far more value than Skygate directly captures. When you evaluate it purely on current or near-term revenue metrics, it looks expensive. When you evaluate it on the basis of the ecosystem value it enables and the fraction of that value it can extract over time, the math looks very different.
It's a different unit of analysis entirely.
Exactly. And the source materials are essentially arguing that the right unit of analysis for Skygate is the ecosystem, not the company in isolation. That's a legitimate analytical framework. It's how you'd evaluate the value of a port or an airport or a power grid. The question is whether Skygate's platform is genuinely analogous to that kind of infrastructure, or whether the analogy flatters the company more than the reality warrants.
And that's ultimately a judgment call that requires watching how the adoption dynamics actually play out.
It is. The source materials give you the framework for making that judgment, but they can't make it for you. What they do well is lay out the conditions under which the accelerated growth thesis is correct and the conditions under which it isn't, which at least gives you a clear set of things to watch for as the story develops.
Here's what this really comes down to, I think. We've covered a lot of ground today. The platform multiplier effect, the adoption compounding dynamic, the valuation step functions, the acceleration defensibility loop. And what ties all of it together is a single underlying bet, that Skygate can achieve load-bearing infrastructure status before the competitive window closes, and that the economic returns to that position are large enough to justify the capital required to get there.
That's the cleanest summary of the case I've heard. And I'd add one more layer to it. The source materials are essentially arguing that the cost of being wrong about acceleration is lower than the cost of being wrong about caution. If you accelerate and fail to achieve the infrastructure position, you've lost the capital deployed. If you're cautious and a competitor achieves the infrastructure position instead, you've potentially lost the entire market. That asymmetry is what makes the economic case for accelerated growth so compelling on its own terms. The downside of caution is potentially larger than the downside of aggression. That's a genuinely interesting way to frame the risk calculus, and it's a frame that applies specifically to winner-take-most markets. In a market where multiple players can coexist profitably, caution is a reasonable strategy. In a market where the infrastructure position goes to one player and that player captures a disproportionate share of the value, caution is actually the riskier bet. The source materials are making the case that Skygate's market is the latter kind.
So what should listeners actually take away from this? If someone is trying to evaluate Skygate's economic case for themselves, what are the 2 or 3 things they should be watching for? First, watch the adoption compounding signal. Is organic adoption starting to exceed driven adoption? That's the clearest early indicator that the flywheel is real. Second, watch the depth of dependency. Are participants building critical workflows on top of Skygate, or are they using it for peripheral functions that they could easily replace? And third, watch the competitive landscape. Is the window for achieving the infrastructure position still open, or is a competitor starting to establish the same kind of load-bearing position?
Those are concrete, observable things, not just, does the stock go up?
Right. The stock price will eventually reflect the underlying dynamics, but the underlying dynamics are what actually matter. And the source materials give you a framework for evaluating those dynamics that's more useful than just watching the valuation number.
I want to give you the last word on this. What's the thing about Skygate's economic case that you find most genuinely interesting, not just as an investment thesis, but as a story about how value gets created?
What I find most interesting is the self-reinforcing nature of the acceleration argument. Most investment theses are about finding something undervalued and waiting for the market to recognize it. The Skygate thesis is different. It's about the act of investing and accelerating being itself the thing that creates the value. The trillion-dollar outcome isn't sitting there waiting to be discovered. It's being constructed through the process of aggressive adoption and ecosystem building. That's a fundamentally different kind of economic story, and it's one that I think we'll see more of as platform economics become more central to how value gets created.
The value isn't discovered, it's constructed. I love that framing. Okay, so here's where we land. We started this episode with the counterintuitive idea that slowing down would destroy more value than burning capital at full speed. And what we've unpacked is why that's not just a provocative claim, it's the logical conclusion of a coherent economic framework built on platform multipliers, adoption compounding, and the winner-take-most dynamics of infrastructure markets. You now understand how Skygate's valuation timeline is actually constructed, why the acceleration defensibility loop makes the case self-reinforcing, and what to watch for to evaluate whether the thesis is playing out as the source materials predict. The question isn't whether a trillion-dollar outcome is possible, the framework shows it is. The question is whether Skygate can execute fast enough to make it inevitable. And that, as always, is the part nobody can tell you in advance.
Well said. And I'd just add, the fact that the economic case is internally coherent doesn't mean it's guaranteed. It means it's worth taking seriously, which is more than you can say for a lot of trillion-dollar narratives.
That's the right note to end on. Thanks for joining us on Copilot Podcasts. If Skygate does hit that trillion-dollar mark, remember, you heard the framework here first. And if it doesn't, well, at least now you know exactly which assumptions to blame.